What's up, everyone? This is Kenny here from Property Stories. So this is from my Age Prop Instagram post. It shows the end of 2023, the country's aggregate household debt total 1.53 trillion. So out of that, the biggest portion, as you can see here, is housing loan. The second biggest is hire purchase, purchase of cars. Third is personal financing. So it's all this. These three is the top lah, as expected. So when you see this kind of data, right, most of the time, what will you be thinking? So I want to offer you a different perspective on how to look at data. I want you to think and ask yourself, where is the money coming from? Where is the real money coming from? Okay? So next, before we talk about this, I want to take just the housing loan part. The housing loan part is 61%, all right? So out of 1.53 trillion, 60% is the housing loan. It's total banking system. So meaning to say 0.918 trillion is housing loan. Banks, when they talk about earning money, you have to base on this term here, net interest margin. Remember, the bank's business is to lend money and collect interest. That is their profit. In the conventional businesses, we will say profit, but in the banks, it's net interest margin. So how does that interest margin calculated? This is from Investopedia. Okay, I just lift it off direct from Investopedia. Difference between the financial firm interest income and interest expenses expressed as a percentage of the income generating assets. Very confusing, right? Let me just go straight. This is the formula, okay? Investment return minus interest expense over average earning asset. This is the formula calculating the interest margin, given by Investopedia also. So this is an example. Let's just say the savings account interest is 1% per annum. Total deposit value 10 million. We're talking about 1 year. Then housing loan interest is 4% per annum. It lend out. Okay. And new housing loan disbursed also 10 million. You'll be wondering, how come deposit value is 10 million, you can disburse also the same 1-to-1? Okay. This one is due to another thing that the banks can do. It's called the fractional reserve banking, but I'm not going to touch about this. But basically what it means is that whatever that you actually put inside a savings account, the bank does not have like 1-to-1. It has leverage, 1 to something, a very high figure, okay? So that's why the bank wants you to put money with them so that they can lend out and earn more money. They can multiply the money actually. Okay, back to this example. Total housing loans portfolio example, let's just say that year is only 12 million. So net interest margin, remember the 4% just now, is investment, the formula here, investment returns over interest minus interest expenses, IR minus IE, okay? So in the balance sheet, you have already invested 10 million at 4% per annum by lending it out as a form of housing loans, okay? Your costs, I'm ignoring every other thing, only talking about housing loan. Your cost is 1% per annum, okay? So that's why investment return minus investment expenses. 4% times 10 million minus 1% times 10 million over the average earning asset. So now your housing loan portfolio total is 12 million. Based on this, how much you're earning? So 0.4 million minus 0.1 million over 12 million is 0.025. So the net interest margin here is 2.5%, okay? Actually, I found the information. This is from Trading Economics. The bank's net interest margin across the board, bank-wide for Malaysia, industry-wide, is 1.9566% per annum. Okay, and this is 2021, and this is sourced from World Bank on March of 2024. So it's actually the latest information that we can get 2024 source, they don't have 2022 and 2023, so never mind, we just use this figure. So again, we see just now, right? The household debt 1.53 trillion times 60%. I just lower it down, like 61.2, I lower it down, 0.918 trillion, okay? So 0.198 trillion, I just take 2%. This is 1.9566, right? I take 2%, okay? So it's actually 0.01836 trillion, which is times, yes, how big is a trillion? 9 is a billion, has 9 zeros, trillion has 12 zeros, okay? 10 to the power of 12. So it's actually equivalent to 18.36 billion. How big is this 18.36 billion? Can you imagine it a bit? So we talk about infrastructure. How much to construct infrastructure? You can see LRT line 3 is only 16.63 billion. So that means if you take the whole profit, mind you, only for housing loan from all the banks, only for housing loan, per profit can build one LRT line 3. Okay, that is how much the bank is earning. And this one is Sungai Besi MRT line 1, 21 billion. The bank's profit every year can actually build already. You just take it like this. Okay. Then this one is MRT 2, 13.11 billion. Sure we can build one MRT 2 already. Sungai Highway, Seri Petaling Ulu Klang Expressway, Suki 5.7 can 6 billion. You can build like what, 3? So what is my message here today? Why I'm sharing with you all this data? I just want you to think that maybe sometimes buying real estate, owning real estate, investing direct in real estate may not be the safest way for you to achieve your goal. Okay? There is something that is guaranteed, more guaranteed than that. So what's my message here, ladies and gentlemen? My message here is that sometimes it makes sense for us to buy the business instead of the product that the business produce, product or services that the business produce. Allow me to explain. In this case, I've shown you who's the real winner here. It's definitely not you and I as a real estate investor or owner. Okay? So in this case, it might make more sense for you and I to buy the business, which is the bank stocks, compared to buying a property. I'm talking here not just about property from developer, property sub-sale or auction. It doesn't matter, okay? I'm referring to buying a property in general, owning a property in general, okay? Here you have something that is not guaranteed. Rental income is higher risk. It doesn't matter where you buy from. If you buy from sub-sale, who knows? It might not be that hot anymore, but you can get rental and you also get the hassle of rental. If you buy under con, you might go out of fashion. You buy auction, you still need to furnish and all this. So rental, you may expect a figure, but you might not get it. Okay? I'm not saying that the dividends in the stock is guaranteed, but you can see the performance over the years. Compared to the dividends, you don't have to manage anything. You just buy and you just let it sit there and let it grow. Okay? This is also something that I want to share with the young ones that you are just graduated and just is your first job. So you're thinking, hey, maybe I should save money, buy house for investment, buy property for investment, so that I also can become rich. I can say that this is what I actually thought as well. But maybe times have changed. When I first started is 2010. This year, you might want to think of buying the bank stock instead. Alright? And put your property investing aside as what I've shared earlier regarding rental income. Okay? So I think at the end of the day, even the capital to obtain this dividend income now compared to last time is so much lesser than the capital outlay that you need to get the rental that you want. Okay, so you need more cash upfront. Yes, I know. Can 1090, okay, 1090, and technically, if you want to count, is is you actually earn much more if you own than owning a stock. But that is all is on paper. I'm talking about reality and applications here. Okay, reality and application is different from paper. Paper gain is paper gain. That's why they call it paper gain. Okay. So I hope it gives you a little bit of food for thought. Whenever next time you see this kind of data, think to yourself, what does this data mean to me? How can I apply this data? I use this information and apply to my own investments or your own strategy. Okay? This is Kenny here from Property Stories, and I'll see you again next video. Bye-bye.